Hi class, Renee here. I want to cover chapter 2 for you, an overview. I'm going to go through the slides. I realize you have these, but I want to point out a few things and give you a few tips and tricks. So, from chapter 1, in chapter 1, we looked at the big picture. We looked at the financial statements after all the data was entered, and we looked at the 30,000 foot view. What does it look like when everything's aggregated, and what do we do with it? Now we're going to drop right down to ground level. How does all of that data get into those financial statements? So we're going to look at an accounting cycle. So remember, the functions of financial accounting are to measure those business activities and communicate that information. So the way we do that, we measure the business activities by recording transactions and then preparing financial statements. So we're going to focus on recording transactions for this chapter. So there's 6 steps in measuring these external transactions. These are external because they occur outside. It's a transaction between the company and someone outside the company. First, we use source documents to identify accounts affected by this external transaction. Source documents are things like invoices, sales receipts, those types of things. And then we analyze what happens to the accounting equation when we have a transaction. We assess whether that transaction results in a debit or a credit. We record that transaction in the journal using debits and credits. We post it to the general ledger, and then we prepare a trial balance. So the process really boils down to analyze, journalize, post, and then prepare a trial balance. So we're going to focus on this stuff. First, what's an account? Well, we've used that term in chapter 1 as well. An account is simply a place to keep all the transactions related to that particular item over a period of time. For instance, cash. What happened to cash? We're going to record everything that happened to cash. Everything is split into types of accounts. So, asset accounts, liability accounts, stockholders' equity accounts. You should be pretty familiar with these by now, and you need to have these down. You need to understand them because that's the basis for everything we'll do in this chapter. A chart of accounts is simply a list of the names of all of the accounts. Not everyone's chart of accounts, not all businesses have the same chart of accounts. But most businesses have the same basic ones: cash, accounts payable, etc. Remember the accounting transaction. So we're going to look at the accounting equation, excuse me. We're going to look at transactions that affect the accounting equation. In order to keep it in balance, excuse me, every time we have a transaction, it has a dual effect on the basic accounting equation. That means if we do something to the asset side, we have to also do something to the liabilities and stockholders' equity side. And I don't want to read all this stuff to you. You can read it yourself. This is kind of important here. Every time we're faced with a transaction, really follow this stuff in your head. Say to yourself, what's one account affected by the transaction? You can almost always figure that out. You can at least figure out one account. And then you ask, does this account increase or decrease? And then ask yourself, what's the second account affected by the transaction? And does that account increase or decrease? And then, do assets still equal liabilities plus stockholders' equity? They have to every single time. Now, you're not going to have to figure this out once we get into debits and credits, but I want to show you the effect, what happens. So we have all these transactions. I'm not going to go through every single one, but I want to go through a few of them, ones that I know are problematic to students. So the first one, the company issues common stock. Well, you have to understand that the company is a separate entity. It's issuing common stock to the people that will become the owners of the company. So when the company sells shares of common stock, the company gets cash, and the shareholder gets a stock certificate. So what's one account affected by this transaction? Well, we know it's cash because they sold shares of common stock for $25,000. That's cash. So cash is one of the accounts. Does the company's cash account increase or decrease? Well, it increases if they got $25,000. The second account, they're selling shares of common stock. So common stock is the second account affected by that transaction. Does it increase or decrease? Well, it increases because it was 0 and now it's 25,000. In other words, there's owners in the business. There's a balance in the common stock account, therefore equity. What does that look like? It looks like this. Cash increases and common stock increases. So we still balance. The company borrowed cash, $10,000 from the bank, and signed a note. They're going to pay that in 3 years. We're going to ignore interest and all of the payments stuff for right now. Let's just get the big picture. One account affected by that transaction is cash. Cash increased, so plus cash. Another account, because we signed a note, is liabilities, notes payable to be specific. That increased. So we still balance because we increased each side by 10,000. We purchased equipment necessary for giving soccer training for 24,000 in cash. Again, what's one account affected by this transaction? Cash is one of them. Well, did cash go up or down? If the company's paying $24,000 in cash, it must have gone down. So minus 24,000. They're getting equipment, which is another asset, so that goes up by 24,000. So we didn't even do anything to the right side of the equation. Total assets didn't change. We simply changed the composition of the assets. So be careful because this is a question. It could be a quiz question. It could be an exam question that says, we purchased equipment for $24,000 cash. How much did total assets change? Well, total assets didn't change at all, and neither did liabilities and stockholders' equity. So think about the results of that transaction before you answer these types of questions. Here's a tricky one. We pay 1 year of rent in advance. Our rent's $500 a month, but we paid a whole year in advance of $6,000. That's not rent expense. That's another asset called prepaid rent. So again, we're paying cash. Cash reduces, but another asset called prepaid rent increases. It's an asset because we haven't used it yet. Each month as we use it, we will reduce the $6,000 by $500 and move that $500 to expense. We'll learn about those types of things in chapter 3. This is just gives you a heads up. So when you pay something in advance, it's an asset to you because it goes in an asset account. If you don't use it, you'll get it back. Here's another tricky one. We purchased supplies on account. And I know you ran across this in the in-class assignment where it just listed supplies. It didn't say supplies expense, it said supplies. So supplies is an asset because we haven't used it yet. It's kind of a prepaid asset, just like rent. The other tricky thing about this one is this on account. We did not pay cash. We charged it to our account. How do we handle that? Well, if we purchase supplies on account, our supplies asset went up by $2,300, but so did our accounts payable. That went up by $2,300. We did not pay cash yet. Later, we'll pay this $2,300. But for now, it's sitting in accounts payable. We still balance. Now let's talk about the accounting equation. We're going to expand it in this chapter. Stockholders' equity includes these two accounts. For now, we'll add more later, but for now we have just these two accounts, common stock and retained earnings. From preparing the financial statement, you know that retained earnings is made up of some things. It's whatever you started with, plus the net income from the income statement, minus the dividends that are paid out to stockholders. And that's the ending balance in retained earnings. So what we're saying then is revenues minus expenses minus dividends is the balance in retained earnings. That's an expanded accounting equation. Revenues increase retained earnings, expenses decrease retained earnings, and dividends decrease retained earnings. And that makes sense, right? We're going to increase it by the net income, or by the revenue, not the net income. The difference between revenues and expenses is net income or net loss. Okay. We provide soccer training to customers for cash, $4,300. There's that term, cash. How much cash did we get? We got $4,300. So we know our cash is going to increase by $4,300. This is what we do in our business, is we do soccer training. So we're going to increase retained earnings. In other words, we're going to increase revenue, which increases retained earnings by $4,300. And we're still in balance. Here's another tricky one. Provide soccer training to customers on account for $2,000. So we provided the training, but they have not paid us yet. They owe us. We call that accounts receivable. So our accounts receivable increases while our service revenue increases. Our revenue increases because we did provide the service, we earned the revenue. We just have not been paid yet. So we have something called an accounts receivable, which is an asset to us. We still balance. Receive cash in advance for 12 soccer training sessions to be given in the future. Keywords, in advance. So we got some money, but we haven't provided anything for it yet. So it's technically not really ours yet. Because if we don't give the training, we have to give the money back. So we got cash, $600. But we have something called deferred revenue. This is a new type of account for this chapter. Deferred revenue is not revenue. Deferred revenue is a liability. Sometimes it's called unearned revenue because we haven't earned it yet. We owe a service for this $600 before we can increase our revenues. So we increase cash because we got it, but we also increase a liability called deferred revenue. If we don't provide the training, we have to give back the cash. Still in balance. So don't let that account name fool you. That's a common mistake. If you see that term deferred, know that it is not a revenue. We pay salaries to our employees for $2,800. One of the accounts is cash, $2,800. We paid out $2,800. We're also going to decrease retained earnings. Specifically, we're going to increase our expense account, which decreases retained earnings by $2,800. We're still in balance. We pay cash dividends of $200 to shareholders. So here we are at the end of the period and we're paying dividends to the owners. Well, we pay cash, so we know one of the accounts is cash. Decrease cash by $200. We're also going to decrease retained earnings by $200 by increasing our dividend account. Dividends decrease retained earnings, so we're increasing our dividend account and decreasing our retained earnings. still in balance. Okay, so now think about this. This is what we just did. This is what it looks like. Now, this was only 10 transactions, and look at the size of this sheet. Imagine if you had to do this with thousands of transactions and many, many more accounts than we have listed here. It becomes cumbersome very quickly. So we have a system for that. Us accountants have a system for that. It's called debits and credits. And if you're interested in where the term debits and credits came from, you can actually Google it. It's a kind of an interesting story. So I always ask my students, what does debit mean to you and what does credit mean to you? Obviously, you can't answer me. So a lot of times when I ask this question, a student will say, well, debit means debit my bank account, use my debit card. A credit means I have a credit card, I'm going to use it. The bank gave me a credit. Those types of things. In accounting, it does not mean that at all. Forget everything you know about debit and credit. In accounting, debit means the left side of the T account, and credit means the right side of the T account. And we'll talk about T accounts in a minute. So debit means left, credit means right. That's all it means. It does not mean increase or decrease. It means left and right. So try to wipe that preconceived notion of debits and credits out of your head and start over. So how do debits and credits affect the accounts in the basic accounting equation? You need to know this stuff, whether you get yourself a note card or you print out one of these slides, however you do it, have something for a reference, a quick reference as you do these problems. The more you do it, you'll get so you remember it. Don't try to memorize it all at once. Get yourself a reference card and use it. No, you can't use it on an exam, but by the time you get to the exam, you won't need it. Trust me. So, assets are increased by debiting them. Liabilities in stockholders' equity are increased by crediting them. Exact opposite. Left side, assets increase with debits. Right side, liabilities in stockholders' equity increase with credits. If you don't have to remember increase and decrease, you have to remember the opposite is true to decrease any balance. So if I debit an asset to increase it, I must have to credit it to decrease it. And we use a T account. This is a T account. And we'll get into that. But a T account is simply the account. So this might say cash, and it has a T. And I post a debit to the left side and a credit to the right side. If it's cash, I'm debiting the left side to increase it, and I'm crediting the right side to decrease it. Then when I net these two sides, I get a balance. This is the best slide for you to use as a reference. It gives the expanded accounting equation and what happens to accounts. So, assets equal liabilities plus stockholders' equity. You can start by saying everything on the left side of the equation gets increased by a debit. Debit means left. Everything on the right-hand side of the equation gets increased by a credit. Credit means right. However, there are some exceptions. There are two exceptions to that when we do this expanded accounting equation. Expenses and dividends. They're the opposite. You credit them to decrease them while you debit them to increase them. That's the only exception, expenses and dividends. Find a way to remember this. There's many ways you can Google how to memorize debits and credits. There's acronyms. Here's an acronym, dealer. So you debit dividends, expenses, and assets to increase them. You credit liabilities, owner's equity, and revenue to increase them. So dealer. That's a good one. There's another one called dead. You debit expenses, assets, and dividends. So that's dead. If you don't remember this, you're dead. You credit everything else. So there's other memory aids that you can look up. Find a way that works for you, whether it's this screen or this screen, however, or something off Google. Find some way to get this down and print something, because when you do these problems, what I don't want you to do is go look up a similar transaction and just copy it. You won't learn it that way. Use one of these things, and every time you do a transaction, look at it. Pretty soon you won't have to look at it. So, analyze. Remember the analyze, journalize, post? So we analyzed each transaction. That's what we just did. We analyzed it. Now we want to journalize it. This is what a journal looks like. It starts with an account name, a date, an account name, a debit amount, another account name, and a credit amount. Here's the important part. You must enter your debits first. If you enter the credit first, even though you put it on the correct side, and you enter the debit next, and even though you put it on the debit side, and you have the correct amounts to the correct accounts, it's going to mark you wrong because you didn't put the debits first. There's also an indent on the second one, which you won't have to worry about because you're going to be doing everything in Connect. And honestly, in real life, we don't worry about indents because we do everything on the computer anyway. So this is the format for a journal entry. We used to do all of this in a paper-based journal, and yes, I'm old enough to remember that. I remember using my first computer to do accounting. I was just thrilled. So when we did it in paper-based journals, that's where journal entry came from. And I just want to run through a couple of these to show you how it works. So remember the first transaction where Eagle Soccer Academy sells their shares of common stock to investors for $25,000 cash. Well, cash is an asset. We want to increase it, so we debit it. So here's where knowing the types of accounts comes in. And I'm going to put up a separate sheet that you can practice with debits and credits. It's similar to the one I posted last time where it listed the accounts and what financial statement they go on, except this time we add in debits and credits. So cash is increased because it's an asset, or we debit cash because it's an asset and we want to increase it because we know cash increased. Common stock was also increased for $25,000. That's a stockholder's equity item on the right-hand side of the equation. To increase that, we credit it. So we're debiting cash, we're crediting common stock. Posting. Analyze, journalize, post. Excuse me. So we analyze the transaction, we journalize the transaction, and then we have to post it. We're going to post it to the general ledger. General ledger takes it from a single transaction with two different accounts and adds everything up within the accounts. So for this one, let me just go back here for a second. And this is what it used to look like. It used to look like a journal, sort of, only it's a general ledger. But you see this T? That's why we call it a T account. It's just a shorthand way of doing this. So we have our debit, we have our credit. Posting is a mechanical process. If you follow the rules, you won't have any issues. I don't make you do a lot of posting. I do make you do it in chapter 2, just so you know what it's like. But the reality is, computer systems post for us now. We don't have to do that. So we analyzed and we journalized. Now we need to post it. So we need to post the cash amount, a debit, to the cash account on the debit side. We need to post the common stock amount, a credit, to the common stock account on the credit side. So a journal is a list of everything in date order that happened. A general ledger is an accumulation of all those transactions in each account. If I were to look at the general ledger and see a balance in cash for $25,000 and I want to know what happened, I could go back to the journal. But there will probably be a description as well. Okay, one more. So cash. This is where the company borrowed cash from the bank. They got cash. We increased cash by $10,000 by debiting it. We increased notes payable by $10,000 by crediting it, because cash is an asset and it increased. Notes payable is a liability and it increased. Posting it. Post it to cash. Post it to notes payable. Note the T account here, and we'll get rid of all this busy stuff and just focus on the T account in the end. Like this. We purchased equipment with cash, $24,000. So equipment is an asset. We know it increased because we got equipment. To increase equipment or an asset, we debit it. We paid with cash. We know cash is an asset and we know it decreased. So we're going to credit cash. And then we're going to post to the T accounts. Oops. So this is what it looks like. And we just referenced the journal. Number 3, this was number 3 journal entry. And here we just referenced 3. If we want to know what that 24,000 is, then we go back to number 3 in the journal entry and look. So we're debiting equipment and we're crediting cash. Now I want to point out something important here. How do you get the balance in an account? The balance in an account, a T account, is not the total on this side and the total on this side. The total is only on one side, and it is on the increase side, always. So if you debit that account to increase it, that's where the balance will be. Sometimes accounts get balances that are not normal. You will not have that. Not in this class. Not yet. You're not ready for that. So my balance in cash is $11,000. 25,000 plus 10,000, that's the increase side, minus 24,000, that's the decrease side, equals 11,000, and I'm going to put it on the increase side. My equipment balance is 24,000 on the debit side, the increase side. Okay, I'm not going to do each one of these. You can look through these and make sure you understand how to do them. When you're finished, you will have journal entries. So typically you finish the entire journal and then you post it. So we analyze, journalize, and post for the entire period. So we did the journal, we would have it would look like this. All the transactions, debits and credits. You don't have to add up a journal to make sure it balances. If each transaction balances, and that's another good point that I didn't mention. If you debit an account for $25,000, you have to credit something for $25,000. They have to equal. Your debits must equal your credits. You can't debit something for $25,000 and credit something for $20,000. It doesn't balance. It's wrong. You could debit one account for $25,000 and credit one account for $20,000 and another one for $5,000, as long as your total debits equal your total credits in your journal entry. Okay, so you did your journal, then you posted all of your transactions to the T accounts. Here's all your T accounts. Here's your cash account with all the increases and all the decreases. We took all the increases, we subtracted all the decreases, and we came up with a balance of $6,900. And the other thing is, whichever side's larger is the side that has the balance. It's that simple. If there were more credits than debits, then the balance would be on the credit side. But if you come up with a balance on a side that's not the increase side, then you have a problem. So you might want to double check your numbers. So we've posted all of our transactions to all of our accounts, and we've given balances for each account. So we analyzed, journalized, and posted. The next step would be to prepare a trial balance. This is where we just list all of our accounts. If it has a debit balance in the T account, you put it on the debit side. If it has a credit balance, you put it on the credit side. Be sure you transfer these correctly. That's a good way to make a mistake. When you're finished, you add up all your debits, you add up all your credits, and your total should equal. What do you do if they don't? Well, double check that you transferred everything correctly and put it on the correct side. Double check your math, and then look at the difference between the sides. The other thing that's pretty common is if the difference between the two sides is divisible by 9, and this is an accountant's trick, if it's divisible by 9, it might be a transposition. That means you wrote down $9,600 instead of $6,900. You transposed two numbers. Transpositions you can always find if they're divisible by 9. Just a little trick. Make sure these two balance. Does this tell us everything is absolutely correct? No, it does not. It just tells us that every time you debited an account, you credited one for the same amount. Okay. I'm going to do an example next. A rather extensive example. I will upload the blank Excel spreadsheet and the filled out Excel spreadsheet for this example as well. It really helps to practice this, and this is a comprehensive example. Okay, so this is P2-8A in your textbook. You can open your textbook, either your electronic version or your paper copy if you have one, and follow along because I won't be showing this again. It's too confusing to go back and forth. But this says that this company had the following balances at the beginning of September. So this was the trial balance they started with. And this is an important concept because if you started with some amounts in your account, you want to go ahead and put those in there before you make the current month transactions. And we'll do that in a second. And then it tells us they have these transactions during September. So they've listed a number of transactions in September. We're asked to record each transaction, so we analyze and journalize. We're asked to post each transaction to the T accounts, and then calculate the balance of each account at September 30th. And there's that hint. Be sure to include the balance at the beginning of September in each T account. And then trial balance. So we analyze, journalize, post, and create a trial balance. That's the accounting cycle. We'll finish the accounting cycle in the next chapter, but for now, it's analyze, journalize, post. Okay. Let's pull up the Excel sheet. Let me get organized here. I'm sorry. I need to move this to my other screen so I can see it. So what we have here is an Excel spreadsheet, and we're not going to always use Excel. It's just helpful for this example. So first we need to journalize the transactions, and here's our general journal. And then we post, and here's our general ledger T accounts, and then we create a trial balance. So 3 steps, 1, 2, 3. Let's start with, I like to start with the balances in the accounts. And if you look at that trial balance that they gave you for September 1st, you'll notice that it has the accounts listed and the debit amount and the credit amount. So it says cash had a debit balance of $6,500. So I'm going to go here to cash and I'm going to put $6,500 on the debit side. And I might make a note here that says beginning. just so I know that's my beginning balance. So I want to do that for all of these. Accounts receivable is an asset, and it has a beginning balance of 2,500. So I'm just going to go through and put these in, just so I don't forget later. Supplies has a beginning balance of 7,600. It's good practice to just do this in advance and have it done. Now, accounts payable says it has a beginning balance. It's a credit balance. They don't always tell you whether it's a debit or a credit balance, but in this case, they did tell you because they gave you the trial balance and it shows you. So my beginning balance in accounts payable was 7,500 credit. Notes payable, it was 3,000 credit. Common stock, it was 9,000 credit. Okay, now I have all my beginning balances in. That way I know I'm not going to forget them. Now I'll move to the transactions, the monthly transactions. So on September 1st, so 9/1, it says they provided services to customers for cash, $4,700. Think about that. What's one account that you know in this transaction? Well, probably cash, right? Cash increased by $4,700. Cash is an asset. In order to increase it, I must debit it. So I'm going to debit cash, $4,700. What's the other account in this transaction? Well, we provided services to customers. So we want to credit some sort of revenue. Look at your chart of accounts, your T accounts, and see what's available. Service revenue is available, so that's what we're going to use, service revenue. And you notice I'm not doing the indents. Service revenue, and we want to credit it for exactly the same amount, $4,700. September 2nd, we purchased land with a long-term note for $6,400 from Crimson Company. What did we get? Well, we got some land. So land increased, and land is an asset. In order to increase an asset, I'm going to debit it, land. And the amount was $6,400. We didn't pay for it, we signed a note. So we have an account called notes payable. We will credit that $6,400. Next transaction, September 4th. We received an invoice for $500 from the local newspaper for an advertisement that appeared on September 2nd. It's important to know when the advertisement ran, whether you actually owe the $500 yet or not. So we received an invoice means we haven't paid it yet, we just received an invoice. That would be accounts payable, right? But what about the advertising? What would we use? What fits here? Oh, look, there's an advertising expense. And just know that you always debit expenses, always. You're not going to credit an expense. So we're going to debit advertising expense. It's an expense account. To increase that, you debit it. We're going to debit that $500. We haven't paid for it yet, but we owe it. It's a general account that we owe, a short term, so we're going to call that accounts payable. That's a liability. We want to increase it, so we credit it. September 8th, provide services to customers on account. There's that term, on account. That means we didn't get cash, but the customer owes us. If the customer owes us, it's an accounts receivable. Accounts receivable is an asset, and we want to increase accounts receivable, so we will debit it. So 9/8, we're going to debit accounts receivable. We're going to debit that for, what was the amount? $6,000. Okay. Well, what was it that we did? We provided services to customers on account. So this is actually service revenue. We provided those services, so we earned the revenue. We just haven't received it yet. September 10th, purchase supplies on account. So September 10th, when we purchase supplies on account, there's that term, on account, that means we didn't pay for it yet. But we got supplies. Supplies is an asset. So we will debit the asset because we want to increase supplies. The amount was $1,100. We haven't paid for it yet, but we do owe it, so we're going to credit accounts payable. Okay? September 13th, pay $4,000 to Crimson Company for a long-term note. If you remember back, look back on September 2nd, we purchased land with a long-term note for $6,400 from Crimson Company. So we owe Crimson Company $6,400. In order to pay it, we're going to pay part of it. We're going to pay $4,000 of it on September 13th. So we're paying cash. Well, we could just go down here. We know cash is going to go down, and it's going to go down by $4,000. So we know we have to credit cash. We know we're going to debit something else for $4,000. What would it be? Well, we increased our notes payable by crediting it. How do we decrease it? Well, we decrease it by debiting it. So we want to debit notes payable for $4,000 and credit cash for $4,000. That shows that we owe less because we paid part of it. September 18th, receive $5,000 from customers on account. So back here where we provided revenue, or we provided a service and earned revenue, but the customers owe us $6,000, now they're paying some of that to us. What are we getting? We're getting cash because they're paying us. Cash is an asset. We want to increase it. We receive $5,000 from the customer. Here's a common mistake. We need to credit something $5,000. It's not going to be service revenue because we've already credited service revenue for the whole amount. What we're going to credit is accounts receivable because that's an asset, and crediting it reduces it. So it shows that we owe less. We started out with $6,000. They paid us $5,000, so now they owe us $1,000. But we had a beginning balance, so we need to take that into consideration, and we'll see what happens when we start posting. September 20th. We pay $900 for September's rent. That's a rent expense. We want to increase rent expense, and you'll see that that's down here in our chart of accounts. We want to increase rent expense for $900. We paid it, so we must have paid it with cash because it didn't say we paid it any other way. We want to reduce cash by $900. September 30th. We pay September's utility bill for $2,000. Well, we had a bill for utilities, so that's utilities expense. We always debit expenses, and we want to increase the expense. In order to increase an expense, we debit it. Debit utilities expense, and the amount of the bill was $2,000. We paid it. Well, if we paid it, we're going to credit something for $2,000, and that would be cash. Cash is an asset. In order to reduce it, we credit it. September 30th. pay employees $4,000 for salaries for the month of September. So again, salaries expense. We always debit expenses, so we're going to debit salaries expense for $4,000. We need to credit something for $4,000. If we paid it, and hopefully we paid it in cash because our employees will not be happy if we didn't, we credit cash, reducing cash by $4,000. And the last transaction is at September 30th as well. We pay a cash dividend of $1,100 to shareholders. That goes to the dividend account. We always debit dividends, never credit them. Dividends are increased by debiting them. So we're going to debit dividends, $1,100, and we're going to credit cash, $1,100, because we're reducing cash. If you can't remember whether to debit or credit dividend, you know you have to credit cash, right? Because cash went down. So then you know you have to debit dividend. The same for this expense. You don't want to debit cash because if you debited cash, it would increase it. You know your cash is going down. You have to credit it. So you know you have to debit something else. Sometimes you can work backwards on these. So now, we have recorded all of our transactions. We've analyzed and journalized every transaction. Now we want to post. And the best way to post is to don't go through and pick out cash, 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 and then post it. That leads to mistakes very easily. Do each transaction. So, and we want to date it too. So we're going to debit cash on September 1st, and we're going to reference it with the date. Sometimes they'll ask you to reference it with a journal entry number, like number 1, number 2, number 3. So we're going to debit cash $4,700, and we're going to credit service revenue $4,700. So we're going to go down here and put $4,700, and I'm going to put the date just as a reference. So these two are done. I'm going to mark those off. I know they're done. Next transaction, we debited land and we credited notes payable. So debit land for $6,400, credit notes payable for $6,400. And I'm going to put the date here. And I'm going to mark it off because I posted it. And now I'm just going to go through and post each one of these, and you can watch me as I post. Advertising expense down here. So I'm going to pause this now, and then I'm just going to post the rest of them, and then we'll continue. Okay, I want to show you a couple of things. So I posted the notes payable debit to notes payable. I want to post the credit of cash to cash. I don't have to skip this row and this row. I can start right up here, or even start on the second one because the first row are beginning balances. So start on the second one, and I'll post the $4,000. Oops, 4,000. And that's important because you'll get stuck on a homework problem because you won't know that you don't have to have these rows separated. Okay, everything's been posted. I saved you from some of the tedium of watching me post. Posting is a mechanical process. It's boring. It's repetitive. You will only have to do it once or twice. And I'm so glad we don't have to do it in real life. So you'll notice that the cash account has amounts on the debit side and amounts on the credit side. The next thing we need to do is create a balance. So I'm just going to draw a line under this because now we have a balance. So we want to put ending balance. And since it's cash and you debit cash to increase it, I know the balance is going to go on the debit side. But I could add everything up, and if the debit side is bigger, that's the side it goes on. So I'm going to add up 6,500 plus 4,700 plus 5,000. Then I'm going to subtract, 5,000. Then I'm going to subtract 4,000, subtract 900, subtract 2,000, subtract 4,000, subtract 1,100. And that'll give me my ending balance in cash of $4,200. Now I'm going to do the same thing over here in accounts receivable. My ending balance, it's an asset, so it's going to be on the debit side. So I'm going to take 2,500 plus 6,000 minus 5,000. The balance is 3,500. Supplies. My ending balance, I'm going to take 7,600 plus 1,100. There's no credits, so I don't have to subtract anything. My balance is 8,700. Land. Ending balance. Again, an asset, so the balance is on the debit side. And I'm just going to add up the two debits because there's no credits. Accounts payable. Balance can't be on the debit side because there's nothing on the debit side. And we know the balance is on the credit side because accounts payable is a liability and you increase liabilities by crediting them. So we're just going to add up all these things and that's our ending balance. Notes payable. We have amounts on both sides, but it's a liability account, so the balance goes on the credit side because that's the increase side. I'll add up 3,000 plus 6,400 and minus 4,000. It gives me a balance of 5,400. In common stock is an equity account. So the balance is on the credit side. And that's the only one that has an amount. So the balance is obviously on that side. Same thing with retained earnings. Let me draw my line. Same thing with dividends. There's only a balance on the debit side. To increase dividends, you debit it. So my balance is on the debit side. Service revenue. There's only amounts on the credit side, which makes sense. You always credit revenues, so the ending balance is a credit balance. Salaries expense. All expenses are always debited, so the balance is always on the debit side. And I'll just do these last couple of expenses. All right, so now we have all of our balances calculated. And I'm just going to highlight those ending balances just so you can see, so it's pretty clear. That way we're not going to make any mistakes. Who knows, I might have made a mistake, but we'll find out here. So highlighting all my ending balances. Not really necessary, but I like to be consistent. So now we analyzed and journalized, we posted, we need to create our trial balance. What we need to do here is just carry these balances over. Again, it's mechanical. So cash, my first account, has a debit balance of $4,200. And I'm just going to link these because that way I know I'm not going to make any mistakes. In order to link, I just hit equal or plus. Accounts receivable has a debit balance of $3,500. So I can hit equal and click on the $3,500 and it's going to move that amount in there. Supplies has a debit balance of $8,700. Land has a debit balance of $17,600. Accounts payable has a credit balance. Notes payable has a credit balance. Common stock has a credit balance. Retained earnings, dividends has a debit balance. Service revenue has a credit balance. Salaries expense, oops, about to make a mistake there. Salaries expense, rent expense, advertising expense, and utilities expense. Now, there is an order on the trial balance, an order of accounts. Assets, liabilities, stockholders' equity. Remember, that's the accounting equation, followed by revenue, dividends, revenues, and expenses. If you put them in this order, it's much easier to prepare financial statements from it. So my numbers total. So I'm good. That's the end of the problem. I will post this solution for you. I will also post a blank Excel sheet so you can practice. Remember, you can look the problem up in your textbook. It is P28A. I encourage you to practice along with this and make sure you understand it. I will also upload a sheet, account classifications with debits and credits, that has the answers on it so you can use that as a practice sheet. You could make a copy of it and take out the answers and drill yourself on it. It's really important that you know the account classifications. Thank you for listening. Have a great day.